Even with the green today, we are seeing mixed markets over the last little while. The TSX, Dow Jones, S&P, WCS crude are all up. NASDAQ was down. It's now up again. WTI crude down. Canadian dollar is declining slightly. So is Bitcoin. There's a lot going on. Let's bring in Art Hogan, Chief Market Strategist at B. Riley Wealth. And Art, thanks very much for joining us.
Thanks so much for having me.
There is a lot going on. A lot seems to be going on during the day, but also for the month. I was surprised to see November's shaping up to be, this may change in the next couple of days, but one of the worst Novembers in 17 years.
Yeah, so November is typically a very good month, and October and September are very typically difficult months. And I think we just pulled forward the seasonality a bit, and October and September actually worked out fine. And some of the concerns about everything that we're thinking about kind of playing out in November. So November actually being down as much as it was coming into this morning was setting up to be one of the worst Novembers in about 17 years. Now, obviously, we got a couple days to make up some ground here, but clearly some of the concerns, clearly focused around AI valuations, focused around will the Fed cut rates in December or not. All of that sort of played into risk-off attitude, and that was really apparent in the first 2 weeks of November, when we had much more significant sell-offs, and last week, where we seemed to have hit the crescendo with the S&P 500 kind of hitting a key level of support at the 50-day moving average and bounced off that nicely. So we were actually down 5% at the low point of the drawdowns here in the month of November, and we seem to have found some support. And the news around AI seems to be migrating for the positive versus that concern, that overarching concern that it had gotten ahead of itself.
Now, does that seem a little firm now, that positivity when it comes to AI, or is it still some turmoil there?
Well, I would tell you this. If you look at the valuations of the top 6 artificial intelligence darlings, or the Mag 6, and if you exclude Tesla from that, because it's not actually an AI play, multiples haven't been this cheap in 2 years, and you're talking about an average 31 multiple for companies that are growing their earnings north of 50%, their revenues north of 60%, and have gross margins north of 65%. So I think the multiples are more rational now than they were a year ago, and certainly don't call into question any type of bubble in the near term. I think the larger concern had been, is there a circular nature to some of the financing of CapEx? And those names that were very extreme in terms of on the speculative edge of this artificial intelligence revolution certainly have seen a much larger drawdown. So we're probably in a better place coming into this week. I certainly think that any of the pullback in NVIDIA is probably overdone. I certainly think the fact that Alphabet, or Google parent Alphabet, is the new leader with its Gemini 3 rollout this week. But I think that leadership is obviously going to evolve over the course of the next couple of years. But in the here and now, it seems like the pole position goes to Alphabet, and that's really driving a lot of the gains today.
And with the news today about chips, does that change anything?
That doesn't really change anything. I mean, NVIDIA has been at the tip of the sword for all of the folks that want to build out large language models. Now, at some point in time, there will be a need for less expensive chips, but we're just not there yet. So I think along the path to this, the dream of agentic artificial intelligence, the folks that want to spend money on chips are going to continue to go to NVIDIA. And after the report last week, we saw that their demand just for next year is measured in the hundreds of billions of dollars, and that's without China. And I would suspect at some point in time, China will be part of that order book, but right now, China is not part of that.
I think sounds like somebody agrees with your strategy there.
I've got 2 very good analysts that want to voice their opinion on that, and I'd love to get them in the shot right now, but they're right over there begging to go outside and chase some squirrels.
I think I have the same analyst at home as well. Overall, for year to date, I was just looking at some of the numbers. Everybody is talking about tech, but I mean, the communication sector has had quite the year.
Yeah, communication services, part of that Mag 7. More importantly to me, utilities and industrials. This artificial intelligence adjacency, we need all sorts of power. We certainly need data center build out. So when you look at the makeup of 11 sectors in the S&P 500, and you actually have 6 of them outperforming the index itself, much broader than we saw last year.
All right, and talking a little bit to everything, the other thing that everybody, of course, is talking about. There wasn't going to be a rate cut. Now it's changed, and we're heading into the quiet period. What can we expect?
Right. Yeah, I think that the fact that we're going to a quiet period is good. The fact that we've gone from a 40% possibility of a rate cut to an 80% possibility of a rate cut is also positive. It's likely going to be a divided decision, so we may have a 7-5 vote, which is okay. It's a committee, so even if Donald Trump introduces a new, very dovish chairperson before Christmas, remember, you need 7 votes in a 12 voter committee, and this one might come down to a 7-5 vote. But I think the fact that we've moved closer to a decision that perhaps in December we're actually going to see a rate cut, the market is celebrating that.
All right. And GDP growth, we're going to see some numbers again. It's looking at about 1.8%. We were talking up here in Canada, it's almost stagnant. Such a different story down there. What's it shaping up down there with the numbers?
I should probably grab this analyst and put him on the shot right now so we'll stop barking. But I would tell you this. The Atlanta Fed, who estimates this, actually has GDP growth north of 2.5%. So the St. Louis Fed, who also does an estimate, is closer to the mean, which is 1.8%. I think GDP growth is going to pick up in the first quarter and the first half of next year, because a lot of the things that this new administration is bringing about, less regulation and more productivity with artificial intelligence, a corporate tax rate that's going to stay the same as it was for a period of time, haven't really played in because we've been so concerned about trade and tariffs. So I think at the end of the day, we're likely going to see earnings growth next year that is as good or better than we saw this year. And we've had double-digit earnings growth for the last 3 quarters.
And we saw some more earnings coming out today. Alibaba having a good one. Analog devices beats as well.
Yeah, I think that it was amazing. We started this third quarter earnings reporting season thinking we'd have about 7%, maybe 7.5% earnings growth. It's north of 13% right now. The more important piece to me is estimates for the fourth quarter went higher and estimates for 26 went higher. So earnings growth and the fundamentals are clearly better. Now, around the edges, concerns about trade and tariff are obviously always there. Concerns about valuations and AI reared their ugly head in the month of November. I think in general, if you're an investor thinking about the long term, the fact that the fundamental picture looks sound is probably a good reason to stick with your diversified investment plan.
All right, we're going to leave it there. There's bear markets, bull markets. You might be in a new dog market. Thanks very much for joining us today.
Thank you so much for being patient with the voice.
Oh, it happens. Cheers, Art. Thanks very much. Art Hogan is Chief Market Strategist at B. Riley Wealth.